What we've been watching over the last few days is not a normal market correction, and it's definitely not price discovery. It's something far more raw than that. This has been a full contact fight, playing out candle by candle between two forces that cannot both win. And for once, the charts are telling the truth loud enough that you don't need a PhD or a Bloomberg terminal to see it. For roughly 72 hours straight, silver has been pinned to a battlefield that just happens to sit around one very specific number, $92. Not 90, not 95, 92. That alone should tell you this isn't random. Markets don't suddenly develop emotional attachments to oddly specific prices unless something important breaks there. Go back to Thursday morning, January 15th, 2026. In the early hours, silver didn't creep higher. It launched. The move was vertical, the kind that makes shorts uncomfortable and market commentators suddenly start speaking very carefully. Buyers weren't tiptoeing in. They were kicking the door down. Within hours, price tagged an all-time high at $92.23. Momentum was building fast enough that $100 didn't feel aspirational anymore. It felt imminent. One clean break and the century mark was in play before lunch. And then, right on cue, the trapdoor opened. Out of nowhere, a wall of selling slammed into the Globex market. This wasn't grandma unloading a few coins, and it wasn't miners hedging responsibly. This was algorithmic, high-frequency short selling, fired off with military precision. In minutes, silver was driven from $92 straight down to $86.20. $6 erased so fast the chart barely had time to draw the candles. Predictably, the headlines followed. Crash. Bubble pops. Speculators burned. The usual script rolled out like it had been pre-written. We were told the rally was over, smart money was gone, and sanity had returned to the metals market. Except that's not what happened. Instead of collapsing, the market snapped back. Hard. Buyers stepped in at $86 with an aggression that clearly caught the short sellers off guard. This wasn't a hesitant bounce, it was a counterpunch. Price ripped back through $88, then $90, and before the session was done, silver was trading around $91.50. The market didn't just survive the hit, it shook it off and stood right back up. That forced the other side to reload. As price crept toward $90 again, the same playbook was deployed. Another wave of paper selling, another aggressive smash. Down we went again, this time to about $87.80. The goal wasn't subtle. Break morale, induce panic, make the bulls doubt themselves long enough to cough up their positions. And yet, here we are. As this is being recorded, silver is trading around 90/30. Up, down, up again. This isn't organic volatility. This is the visible strain of a tug of war where neither side wants to blink. On one end, you have physical demand. Industrial users, sovereign buyers, and investors who understand that silver inventories are not infinite, no matter how many paper contracts get printed. On the other end, you have the paper market, dominated by commercial banks with very specific financial exposure they cannot afford to see triggered. The reason 92 matters so much isn't mystical, it's mechanical. That level is almost certainly tied to a massive concentration of call options expiring this week. Below it, losses are painful but survivable. Above it, those losses move out of the trading book and into conversations with the board. At that point, it stops being a bad quarter and starts becoming a solvency discussion. That hence why they redefending it like it, as the last bridge out of town. To do that, they're burning through ammunition, selling contracts they don't physically possess, slamming price at the thinnest hours, throwing volatility at the market in hopes of exhausting the other side first. The irony is that the very violence of these moves is advertising weakness. In previous cycles, a smash from $92 to $86 would have triggered a cascade. Stops would have been hit, sentiment would have cracked, and price might have drifted back toward $70 over weeks. This time, it took hours to recover. That V-shaped bounce is not a coincidence, it's a signal. It tells you there is a bid underneath this market that S deeper than the banks expect and stronger than their models account for. It's the same physics you see when you push a beach ball underwater. The harder you shove it down, the faster it rockets back up and smacks you in the face. Silver has developed buoyancy, and the harder it's being suppressed, the more obvious that buoyancy becomes. The wild swings are meant to rattle you. 10% daily moves are not designed for comfort. They're designed to make you question your positioning at 3 in the morning, staring at a screen and wondering if peace of mind is worth hitting the sell button. That's the psychological game. But look past the noise. After 2 coordinated attacks, silver is still holding around $90. That's not weakness, that's resilience. It tells us that $80 is no longer home base. $70 is a memory. A new floor is being built, and it's being built under fire. This is the most aggressive suppression campaign we've seen since 2011, and it's happening at much higher prices. That alone should make people uncomfortable. But here's the real question that matters. Who was buying when price looked like it was falling off a cliff? It wasn't retail. Retail freezes in moments like that. The buyers at $86 and $87 knew exactly what they were doing. They weren't reacting to headlines or candles. They were reacting to something else entirely. While New York was panicking, Shanghai wasn't. And this is where the story shifts from the screen to the real world. During the same period that COMEX was painting red candles and commentators were declaring the end of the rally, the Shanghai market barely flinched. The Shanghai Gold Exchange closed with silver trading around $99.69. Let's be honest, that's $100. Call it what it is. Compare that to the intraday low in New York at $86.20, and you're staring at a differential of roughly $13.50. That's not a rounding error. In global commodity markets, that's an alarm bell. Logistics, insurance, and transport don't explain that gap. A $13 spread isn't friction. It's a contradiction. Commodities are global by nature. An ounce of silver doesn't change its properties when it crosses an ocean. Same conductivity, same industrial utility, same scarcity. In a functioning market, prices converge within a narrow band. When they don't, arbitrage takes over. And right now, arbitrage is screaming. For a global trading house, this setup is almost insultingly obvious. Buy silver paper at $87 in New York, stand for delivery, take the physical bar, ship it east, sell it immediately in Shanghai for $100, $13 per ounce. That's roughly a 15% return in days, not months, with minimal market risk. This isn't theory. This is happening. As we speak, metal is moving. Vaults in London and New York are being drained, not because demand disappeared, but because the paper price was smashed low enough to turn the West into a clearance aisle for the East. Every suppression event widens the vacuum, and that vacuum pulls physical silver out of Western control. The geopolitical irony here is almost darkly comedic. Governments hold summits about securing critical minerals. Officials warn about shortages for defense systems, renewable energy, and infrastructure. Meanwhile, the financial institutions, operating inside that same system, are effectively subsidizing the export of silver to China by defending short positions that never should have been that large in the first place. Every time price is smashed to protect a derivatives book, it becomes cheaper for China's industrial complex to lock up real metal. The banks are fighting a local war in New York, but they're losing the global war inch by inch, pallet by pallet. And the battle for $92 is just the opening act. What's really happening behind the scenes is far less glamorous than the headlines, and far more dangerous. The banks aren't defending the market. They're stripping it for parts. They're reburning the nation as furniture just to keep their trading desks warm for one more night, hoping morning brings a miracle. That desperation explains why silver didn't stay at $86 for more than a heartbeat. The market took one look at that price and rejected it outright. An $86 silver price simply cannot coexist with a $100 price in Shanghai. Those two numbers are mutually exclusive. If New York insists on pretending silver is worth $86 while Shanghai is happily paying $100, the result is not balance, it's evacuation. Physical metal leaves the West, vaults empty, and exchanges that rely on confidence suddenly discover that confidence is a finite resource. That's why the rebound to $90 happened so fast it felt almost rude. The market understands that $86 isn't a real clearing price. It's a temporary hallucination created by paper selling. If that illusion were allowed to persist, COMEX inventories wouldn't last weeks. They'd be gone by the end of the month. No exchange can survive a drain like that. At some point, the price has to rise to stop the bleeding. It's not ideology, it's physics. Think of it like a rubber band. The further the banks stretch the New York price away from reality, the more violent the snapback becomes. They can pull it down to $86, maybe even lower for a few minutes. But every inch they stretch it builds stored energy. Eventually, it doesn't drift back. It snaps. That's why the Shanghai price matters more than any candle printed in New York. It's the lie detector. It tells you what silver is actually worth when it's being exchanged for real demand, not leveraged promises. And right now, that number isn't $90. It's not even $92. It's $100. The New York chart, by contrast, has become a lagging indicator. It is distorted by players who are trapped on the wrong side of the trade and are using size and speed to delay the inevitable. But delay is not denial, and it certainly isn't victory. There's another critical message embedded in that $13 premium, and it has nothing to do with speculation. It tells us exactly who's buying in China and why they're not waiting for dips. Chinese demand for silver is not elastic. It doesn't politely step aside when prices rise. China dominates over 80% of global solar panel production. They sit at the center of the electric vehicle and battery supply chain. These industries don't get to pause production because a futures chart looks ugly. A solar manufacturer in Shenzhen doesn't say, let's wait for silver to pull back. If they stop buying, factories go idle, contracts are missed, and market share evaporates. That's not an option. They buy because they must, not because they hope to flip the metal next week. And when supply tightens, they pay up. That $13 premium isn't panic. It's insurance. It's the cost of certainty. What we're seeing is a shift from just-in-time inventory to just-in-case inventory. China isn't hoarding silver because it's fashionable. They're building strategic stockpiles because they see the macro picture clearly. They see debt levels, they see currency dilution, they see the slow erosion of paper purchasing power, and they trust responding the only way that makes sense, by converting financial claims into physical assets. That kind of buyer doesn't get shaken out. You can't scare them with volatility. When price drops, they don't sell, they buy more. That creates a floor under the market that isn't made of sentiment or leverage, but necessity. And that's the key difference between a bubble and a shortage. In a bubble, people buy hoping someone else will pay more later. In a shortage, people buy because they intend to use the thing they're buying. So when you see silver whip from $91 to $87 and back again, don't get hypnotized by the motion. Anchor yourself to Shanghai. As long as silver trades near $100 there, any price south of $95 in the US isn't a warning sign. It's a discount window, one left open by desperation, incompetence, or both. But those windows don't stay open forever. Arbitrage gaps always close, and they rarely close gently. More often than not, they close in a single violent move that leaves everyone scrambling to explain what just happened. It would not be surprising to see a session where silver opens at $95 and closes near $100 simply because the physical drain has to be stopped. That's what the so-called war for $92 really is. It's a war against reality. The banks are fighting to preserve the illusion that silver is worth less than it is. And illusions can persist for a while, but they always lose to gravity eventually. Physics beats paper every time. That $13 premium is proof the paper market is malfunctioning. It's proof that price discovery has migrated east. New York is no longer steering the ship. It's along for the ride, whether it likes it or not, and the ship is sailing toward Shanghai. Now, to really understand why this is spiraling out of control, you have to look under the hood. You have to understand how the price is being pushed around and why the very tactics meant to suppress it are turning into a slow-motion suicide mission. When silver drops $6 in 10 minutes, the natural instinct is to imagine physical selling. You picture warehouses emptying, investors dumping bars, trucks lining up at loading docks. None of that happened. Samsung didn't sell its stockpile. Chinese solar firms didn't liquidate reserves. The US Mint didn't sell anything either, mostly because it doesn't have anything to sell. The selling was entirely digital. It was paper. This is the naked short. Here's how it works. A bullion bank doesn't need silver to smash the price. They don't need bars, coins, or inventory. They only need collateral. They enter the futures market and sell contracts that promise silver delivery at a future date. But they don't actually own the silver. They don't intend to acquire it. They're selling a promise, not a product. When tens of thousands of contracts hit the market in minutes, algorithms interpret that as a surge in supply. Price adjusts downward accordingly. It's a magic trick. Virtual silver floods the market and overwhelms real demand, at least on a screen. For decades, this trick worked beautifully. Banks sold paper, price collapsed, funds panicked, and the banks bought back the contracts at a profit. Rinse, repeat. It was the perfect crime because no one ever asked where the silver was supposed to come from. But something changed. The beach ball effect kicked in. Imagine holding an inflated beach ball underwater. The ball is the silver price. The water is physical reality, industrial demand, tight supply, inflation, and that stubborn Shanghai price. The banks want the ball at $86, but reality wants it at $100. To keep it down, they have to push constantly, and the deeper they force it, the harder it pushes back. When they smashed silver to $86.20, they shoved that beach ball deep underwater. But the moment the selling paused, even briefly, the ball exploded upward. Price ripped back to $91 an hour. That's not a normal market. That yes-so market, whose natural resting point is far higher than where it yes being forced to trade. And this explains the double tap. Why smash it again? Why hit 87,080 after it already bounced? Because the rebound was too fast. It threatened to break back above $92. And above $92, the banks don't just lose money. They lose control. That second smash wasn't strategy. It was panic. In a weak market, one smash does the job. In a strong market, price behaves like a trampoline. The harder you hit it, the higher it bounces. That's what we're seeing now. And look at the open interest data. Normally, when price collapses, open interest falls. That means the longs are liquidating. They're giving up. This time, on the smash, open interest rose. That detail matters. It means every contract the banks sold was met by a willing buyer. The market didn't choke. It absorbed the paper effortlessly. Those buyers aren't speculators. They're likely the same entities pulling metal out of vaults. They're using the futures market as a delivery mechanism. And that's where the trap snaps shut. Every contract sold at $86 is now a liability, a legal obligation to deliver silver at that price. But where will the banks get it? Not from Shanghai. It costs $100 there. Not from dealers. Inventories are thin. Every new short deepens the hole. This is why the strategy has turned self-destructive. The banks are all in on a short position they cannot exit without detonating the price. They know it, and yet they keep doubling down. Because stopping means admitting defeat. That's not a strategy. That's a gambler chasing losses. And the Shanghai price is the margin call. The phone is ringing. At this point, the situation has crossed from uncomfortable into absurd. The reality on the ground and the numbers on the screen no longer agree, and everyone pretending otherwise is simply buying time. The real-world price of silver is already telling the story. On the street, physical metal is changing hands closer to $120. That is not a typo. That is not a premium driven by panic buyers on social media. That is the cost of sourcing real silver when supply is tight and sellers know what they have. The banks can't source metal at that price, and that's the problem. They can't get it from the mines because future production is already spoken for. They can't pull it out of thin air. And they certainly can T-buy it at $86 or $90 without locking in guaranteed losses. They sold something they do not possess at prices that mathematically ensure they will lose money if delivery is demanded. That's not hedging. That's digging a hole and congratulating yourself for how fast the shovel is moving. Their only realistic exit is psychological. They are betting desperately that they can scare holders of physical silver into selling it back to them. That's why the volatility looks unhinged. This isn't about price discovery anymore. It's about breaking resolve. They can't beat the math, so they're trying to beat you. If you hold your position, and if industrial buyers keep doing what they're doing, the banks are not just wrong, they're insolvent. They are short a market that has quietly run out of inventory. That's why the fight around $92 matters. It's not a random technical level pulled from a chart. It's the load-bearing beam holding up the suppression structure. If $92 breaks cleanly, the narrative collapses. Options at that strike get triggered. Dealers are forced to hedge by buying futures. Shorts scramble to cover. That feedback loop ignites a gamma squeeze, and suddenly today's $6 swings look like a warm-up stretch. But there is a danger here, especially for traders using leverage. Cornered animals are not calm animals. They don't behave rationally, they lash out. The banks may try another overnight smash, maybe during the thin Asian Open, maybe with a manufactured headline, maybe with a sudden technical breakdown that conveniently appears on every financial news site at the same time. They will try whatever they can to delay the inevitable. Just remember the beach ball. Every time they shove it underwater, they add energy to the rebound. The $13 premium in Shanghai is not an opinion. It is force. It is gravity. It guarantees that the ball comes back up, no matter how dramatic the push looks on a chart. The paper war is noise. It's a light show meant to distract you from what's actually happening. While screens flicker red and green, vaults are emptying, trucks are moving, ships are sailing. One side of this market is trading digits. The other side is trading atoms. Only one of those wins in the end. As we move toward the conclusion of this deep dive, it's time to zoom out and talk strategy. Not trading tactics, not clever chart patterns, but survival strategy. And it starts with clarity. If you followed this entire battlefield assessment, you now understand the mechanics. You have seen the double tap smash designed to defend 92. You have seen the Shanghai price act as a lie detector, screaming that silver is already worth more than 100. You have seen how naked shorting and paper leverage create artificial crashes that no longer stick. This isn't speculation. It's forensic. Thursday, January 15th, 2026 will be remembered as the day the bullion banks threw everything they had at the market and failed to break it. Look at where price is sitting right now, around $90, $30. Think about that for a moment. Millions of ounces of paper selling hit the market. Price was smashed to $86. And within hours, it climbed right back up as if nothing had happened. That is not weakness. That is strength, hiding in plain sight. So here's the verdict. The 80s are no longer relevant. They are history. The banks have lost the ability to push silver back into the old range. And $92 is not a ceiling. It's a speed bump. An uncomfortable one, yes, but not a wall. Triple digits are not a fantasy anymore. They're a function of time. Now, what does that mean for the individual investor standing in the middle of this crossfire? First, define the endgame. The current suppression effort is tied directly to options expiry. That clock is ticking. Once expiry passes, the incentive to keep smashing the price evaporates. The pressure comes off, and all the energy that's been compressed during this phase gets released. Rubber bands don't relax gently after being stretched this far. They snap. The Shanghai Premium tells you where that snap wants to land. Roughly $13 higher. That's what it takes to close the arbitrage gap and stop the physical drain. A $10 gap up overnight is not extreme in this environment. It's logical. But to benefit from that, you have to survive the final attempts at intimidation. The next 24 hours could be messy. Expect noise, Expect volatility. Expect one last attempt to shake weak hands loose. Your strategy here is not cleverness. It's radical inactivity. Do not trade this market. Do not try to scalp a dollar here or there. Do not attempt to sell at $90 or $92 and buy back at 88. That is how you lose your position and watch the market run without you. If you hold physical silver, you've already exited the casino. You're holding the chips while the house is arguing with the fire department. Let's talk about price again, because this is where the trap closes on the banks. We established earlier that the street price is near $120. If the screen says $90 and the real world price is $120, then silver is effectively trading at a 30% discount on paper. No rational holder sells a discounted asset when supply is tight. They either hold it or they buy more. That's the liquidity trap. The banks need sellers to cover their shorts, but the more disconnected the paper price becomes from the physical price, the less willing anyone is to sell. Instead of dumping contracts, buyers stand for delivery, and that forces the banks to bid the price up against themselves. This is the churn phase. Price grinds higher day after day, ignoring news, ignoring indicators, ignoring sentiment, because the vaults are empty. We've already seen the evidence. Over 1 million ounces left JP Morgan's vault in a single day. That metal didn't vanish. It moved. And it's not coming back at $90, maybe at $200, but not at today's prices. So the verdict on the war for $92 is clear. The line has held. Buyers defended it. Sellers are running low on ammunition. But the bigger story goes beyond silver. What we are witnessing is a transfer of pricing power from west to east. For decades, New York dictated the price of precious metals. That era is ending. Shanghai is now setting the tone. That shift has enormous implications. It means the dollar's privilege is eroding. It means Western banks can no longer print paper metal endlessly to manage inflation expectations. When you hold silver, you are not just holding a commodity. You are holding a vote against that control structure. The volatility we saw today, the crash to $86, the snap back to $91, is the death rattle of the old system. It's the sound of gears grinding as the machine fails. Don't fear that noise. It's confirmation. So what should you actually do tonight? First, secure your position. If your metal is sitting inside the banking system, consider removing it. If it's unallocated, allocate it or take delivery. Counterparty risk is no longer theoretical. The warning lights are flashing. Second, ignore tomorrow's headlines. You'll be told silver is risky. You'll be told it's volatile. You'll be told bonds are safe. You'll be told to trust the system. Those talking points come from the people losing control of the market. Third, zoom out. If silver hits $100 next week, that's not the end. It's the beginning. Adjusted for inflation, silver's 1980 high would be well over $150 today. The gold to silver ratio points far higher than that. We are early. The war for $92 is just one battle. The road to fair value is longer, and it doesn't end quietly. The banks declared war. They fired their shots. They smashed the price. And after all of that, silver is still standing at $90. The metal has spoken. Reality has spoken. Donna T let them shake you out for 86.6 when Shanghai is paying $100 and the street is paying $120. Strong hands win this fight. The paper tigers are running out of paper.